What is the difference between the stock market and mutual fund investing? Stock markets generally means investing directly in the stock of a company. Here, you are purchasing the companies listed on a stock exchange with an expectation to earn profits when the price of the stock goes up. On the other hand, a mutual fund is a collective investment that pools together the money of a large number of investors to purchase a number of securities like stocks, FDs, bonds, etc. A professional fund manager manages this fund. When you purchase a share in the mutual fund, you have a small stake in the investment of the company that you are funding to. Hence, by owning a mutual fund, the investor participates in gains or loss of that fund's portfolio. Now, let's go through some of the differences between the stock and the mutual fund investing. So, first of all, the cost of investing. While investing in mutual funds, you have to pay different charges like expense ratio, load fee, which is entry fee, exit fee, etc. For the top mutual funds, the expense ratio can be as high as 2.5 to 3%. On the other hand, if you invest in the stock market, you have to open your brokerage account, which includes opening account charges, and you have to pay a small annual maintenance charge too. Further, there are also different costs while transacting the stock like brokerage, ST, stamp duty, etc. Nevertheless, if you compare the charges involved in the stock and mutual fund investing, you can find that the cost while investing in stocks are still lower. This is because managing a mutual fund consists of a lot of expenses like management fees, salary of the managers or employees, administration charges, operational charges, etc. However, for investing in stocks, the most significant burden is only the brokerage. Volatility investment. Direct investing in stock has more volatility than compared to the mutual fund investing. This is because when you invest in shares, you generally purchase 10 to 15 stocks. On the other hand, the mutual fund consists of a diversified portfolio where investment in different securities like stocks, bonds, fixed deposits, etc. Even the equity-based mutual fund invests in at least 50 to 100 stocks. Due to broad diversification, the volatility in the mutual fund is a lot less compared to what is that of shares. Return potential. Stock markets investing has a large high return potential. Most of the successful investors in the world and India, like Warren Buffett, R.K. Damani, Rakesh Jhunjhunwala, etc., have built their wealth by investing directly in the stock markets. However, this is only one side of the story. The complete fact of the majority of the people losing money in the stock market, although the return potential is high while investing in stocks, however, the risk is also higher. On the other hand, most of the good ranked mutual funds have given decent consistent returns to their shareholders, although the returns are not as high as what many successful investors can make from stocks. However, this return is enough to build a massive wealth for an average person for a second future. Tax saving. If you invest in ALSS, which is equity linked savings scheme, under mutual funds, you can enjoy a tax reduction of up to 1.5 lakhs in a year under the Section 80C of the Income Tax Act. Another benefit of investing in the mutual fund is that you do not have to pay tax if your fund sells off any stock from its portfolio as long as you're holding the fund. On the other hand, when you sell stocks while investing directly in the stock market, you have to pay a tax. No matter what is the scenario, here are the tax benefits while investing in the stock market. You have to pay a tax of 50% short-term capital gains and tax up to 10%, which is only when the profit of rupees 1 lakh is above on your principal amount on the long-term capital gains. Monitoring. Investing in the stock market requires quite frequent monitoring. This is because the stock market investing is a personal thing. Here, no one is going to do this for you, and hence you have to monitor your stocks yourself. Moreover, due to the high volatility of the stock market, the frequency of the monitoring should be higher, at least even quarter of or half yearly. On the other hand, for the mutual fund, there are fund managers who take care of investments and make the buy or sell decision of your behalf. That's why when you invest in mutual funds, you do not need to monitor your fund much frequently. Anyways, you should watch your fund at least every year so that you can confirm that your fund's performance is in line with the goals. SIP investment. Mutual funds investment provides you with an option of a systematic investment plan, which is SIP. The systematic investment plan refers to a periodic investment. For example, the investor can invest a fixed amount, rupees 100 or 5,000 every month to purchase some units of the fund. SIP helps investing automation and it brings discipline to investment strategy. On the other hand, there is no option SIP available in the stock market investing. Asset class restriction. While investing in the stock market, the only asset where you can spend is stock of the company. On the other hand, the mutual fund gives you an opportunity to invest in a diversified portfolio. Here, you can invest in variety of sets classes, for example, debt mutual fund, equity-based mutual fund, gold fund, hybrid fund, etc. Required for investing. The total time needed for directly investing in stock is a lot more compared to that of a mutual fund. This is because a fund manager manages a mutual fund. However, for direct investment in the stock market, you have to do your research. Here, you have to find the best possible stock for investing yourself, and that requires a lot of studies, time, and effort.